Okay. There we go, guys. Sorry about that. A little bit of a delay. Actually, I need a second here. Okay, sorry about that, guys. I'm having a little bit of a trouble here with my recording software, so hopefully we can get that all figured out. Laggy on the computer. Yeah, just give me 2 seconds here, guys, and we'll get this going. Yeah, today we're going to be looking at GSX, though. GSX is... some stuff came out about them a couple weeks ago, and I think there's a really good trade. We were able to put on a 15-to-1 risk-reward trade, which is absolutely wild. So let's have a look here. Okay, guys. There we go. Let's hop on this. Man, oh man. I don't know how the stream started without me having a say in it, but it did. So, okay, guys. Let's talk about GSX. So, GSX basically things were going well for them, you know. They're an online like language school company, and when I took a look at them at first, like, you know, you look at them, stock's doing healthy, stock's been going up, but I came across a report from Muddy Waters Research, which basically outlined that they hold the belief that GSX has a ton of fake users. Let's take that in for a second. GSX has fake users. How can this be? Right? And they're not just saying like a little bit, something to botch the numbers a bit. They're talking, they have 73% of the users, have a high confidence that they're bots. Like, that's nuts. That's absolutely crazy. You know, with another 7.6% likely to be, you know, highly likely to be bots, and then another 19% that are somewhat real. And when we take a look at this, it's like, what the hell is going on here? How can this even be a thing? Right? We go through the research report a little bit. We are short GSX because we conclude that it is a near total fraud. That is a bold accusation to make. A bold accusation. You know, a former GSX manager corroborated their analysis and explained various details of the extensive bot operation. This is wild, guys. How can this even be real? We go through here, right? They are a massive loss-making business. Without users, there's no revenue. We also conclude that they are greatly understating their expenses. No matter how one cuts it, GSX is almost completely an empty box. Wow. Those are bold claims. Those are bold claims. And then there's some other stuff that's making it a little bit more risky to hold. Could force, you know, aggressive selling of the stock, crashing the price. So, okay, look. We take a look at this. This is not good news. But we take a look at the stock. Right? If we go to the stock and we take a look at the price, geez, they're seeing their best few days in a long time. Look, stock's going up. Stock is going up to the moon. GSX to the moon. You know what? You know what I'm thinking here, guys? I'm thinking GSX is exactly following the market. The worse news that comes out, the better the stock's going to do. Right? I didn't know GSX had a bot printer. The Fed has a money printer. They both just hit the on button and let that thing run. You know? Doesn't matter what news comes out. They'll just keep printing more bots. But no, in all seriousness, guys, this is looking like a really good short. But we need to be careful about how we do it, right? So I want to explain to you guys how we put on a 15-to-1 risk-reward trade. Because, guys, this is a pretty crazy thing that's going on. So the trade that we ended up putting on was we put on a put fly. So it's a directional fly to the downside. And we're taking advantage of a couple things there. We're taking advantage of the skew. We're taking advantage of the volatility. And to do this, we need to be able to look a little bit deeper than just the charts, because the average person might come into this space and go, I'm going to buy a put, right? I think the stock is going to go down, so I'm going to buy a put. And look, I totally understand where you're coming from when you do that. It's logical. I think the stock's going to go down, so I need to buy a put. But in order for that to be, is that the best trade we can put on, right? Let's say that Muddy Waters is correct here, and this thing is dirt. This is a dirt company. So how can we take better advantage of this? Because when we look at the skew, right? So I'm on GSX right now. I'm taking a look at the company, and we see this in the skew. So a lot of you might not be familiar with this graph, but this is an extremely important thing to understand in the option space. And even if you're a stock trader, it gives you a lot of insight into, what people are really thinking is going on with this stock. You know how when you go to StockTwits and you can look at the sentiment, it tells you what sort of like the retail sentiment is for the space? Well, when you look at the skew, it's sort of an easy way to understand it is that it tells you where the demand is in the option space. And the option space tells you about the stock space. So when we look at the option chain and we break it down, we can see that the price of the puts is significantly higher than the price of the calls. And the further out of the money you go, the more expensive it gets relative to what you get for it. And like we're talking, this is insane. This is absolutely crazy. The calls all seem to be pretty fair value, but as we go into the put side of things, we're talking like implied moves of, let's see here, if I open my calculator, we're talking implied moves of like 14% a day. Like crazy expensive. Like if you had bought these puts right now, if you were holding these puts, you're losing bank. You're losing bank on these puts, guys. So I want to explain to you guys how I actually structured this trade, what I looked at to be able to do it, and hopefully we can you guys can take this trade as well. I actually posted, so I don't have the Thinkorswim brokerage on here, so we're not going to be going into the brokerage to actually break down the trade right now. But what I will do is I'll tell you this: if you go to our Predicting Alpha Instagram, we have a picture of the trade up, and you can actually shoot me a DM on there, and I can go into detail, like help walk you through placing it. If this is a trade you want to take, keep in mind, guys, this is a trade that comes with risk. We're not putting up a ton of risk for the potential reward, which is why we've taken the trade. But obviously, guys, if the stock continues to go to the moon, GSX turns their bot printer on and it just keeps jumping up, we're going to be taking a hit. But look, let's take a look. So we go to the vol trader here, and we need to focus on a couple things here. For a lot of you guys that don't know, if you're trading the options, you really want to be focused on the volatility, right? What is the market implying the future to look like for this stock? And the way that we get that insight is by looking at the volatility. So we take a look here at the implied volatility in the market, which is 106, and the realized volatility for us, which is our forecast based on if you take out a lot of the biases in the market, what's sort of left. And we're basically saying that the market's implying bigger moves than what we think there'll be. And a lot of this is probably getting driven by this insane amount of skew here. Like people are just buying the puts for any price. They're willing to pay absolutely any price for it. And it looks like the terminal just updated and the skew has come down a bit. It was at 220 before, and now it's at 176. So if we go back to our trusty calculator here, adjust that number, right? So 176 divided by 16, the market went from implying a 14% move a day to an 11% move a day. So our position's probably actually looking pretty good right now. Even though, actually, well, it's gone up 5%, so maybe not looking great right now. But if you guys want to bet on this thing going down, this is the position you want to be taking. You want to be placing a 132 long butterfly to the put side. So you want to be taking advantage of this skew because you can structure a trade that takes advantage of the price inefficiency going on here, right? So you want to be selling some of these and buying some of these to structure a trade where you make money as the stock goes down, but because you've set a range on how much you're gonna where you're gonna profit, you get to really, really capitalize on that, on how much you're paying versus how much your potential rewards are. So, something else to notice is that the relative action has come back down. It was at a 10 out of 10, and it's come back down, which means that a lot of people have probably stopped actively trading. This sort of falls in line with my hypothesis that a lot of funds are short this stock right now because this was really high yesterday. It looks like all the positions are sort of in, and now the action's coming back down, right? When we take a look on StockTwits, we see this doesn't have a ton of retail followers, so there's not really a ton of people looking at this thing from a retail space. So we got to ask, if there's only, if I go to StockTwits right now, right? If I go to StockTwits and I look up GSX and we take a look at the message volume and all of that stuff going on for this stock, right? Let's go to it. Sorry, guys. Whenever I open StockTwits, for some reason my computer just starts to explode. But let's take a look. GSX, 1,900 watchers. So not a ton of people looking. One thing, though, is that if my computer will let me open up this sentiment here. Let's have a look. Come on, open up. 1 second here, guys. Yeah, so it's up over 5% now. But guys, so the reason why I'm looking at this, right? So I saw a lot of people tune in just now. The reason we're looking at this is, Muddy Waters, pretty reputable, right? They came out with a report saying that they hold the belief that a lot of GSX's users are bots. And you know what? I'll play the devil's advocate here, and I'll show you. I have another report here from GSX refuting the information given from Muddy Waters research. So I'll give you that. But what I really want to focus on, guys, is I want to show you what's going on in the market. What is the actual impact of this news? Who's buying what? And why do I hold that belief? And what's the trade that I've taken? So one thing that's really cool, for Big Daddy there. So Big Daddy, nice username, first of all. The thing that I did was, whether I'm right or wrong, look on the direction. Look, it might keep going up, and that's okay. What I'm saying is, I was able to put on a 1 to 15 risk reward trade, so I can play small. And look, if I'm wrong, I can wipe my hands of it, and I'm not gonna be holding anything against myself. I'm not gonna be sitting there. My bankroll isn't on this. I'll be honest, right? Like, we got a lot of other shit on the go. I'm not sitting here stressing about this, but I wanted to break it down for you guys because it is very rare that you will actually get a 1 to 15 risk reward trade. Like, let's think about that. I put in, $100. I had the chance to make $1,500 on this trade if I'm right. So I wanted to place this trade, just simply based on the risk reward. And there seems to be pretty good research that's gone into it as to why this thing should be going down. Obviously, markets can be irrational in the short term, but we want to, we're trying to play, the right game here. And this looks like a good trade. We only need to be right like less than 1 out of 10 times for this to be something profitable to do. So just to break it down for you guys, Muddy Waters came out with a report saying that they are short GSX because they conclude that it is a near total fraud. That's a bold claim, guys. That's a big, bold claim, right? They conclude that at least 70% of its users are fake. And we think that it's quite likely that at least 80% of the users are fake, right? They're based on the attendance data files, user files. It's not from scraping the data themselves. They downloaded it from over 200 paid classes covering 54,000 unique users. A former manager from GSX corroborated the evidence, explained various details of their extensive bot operation. So this is like some pretty serious shit going on with this company, guys. Based on that faking of users, they basically say that there's no way these guys are making money. There's no way these guys are making money. They're probably botching the, there's no revenue. They're probably understating their expenses. Regardless of how one cuts it, GSX is almost a completely empty box. This is very illegal what's going on here if these guys are correct on their claim. But before I move into the trade I placed, GSX did come out and refute the evidence that was provided by Muddy Waters. This came out on May 29th, so just 5-6 days ago. Basically, they came out saying that it's false allegations. After the analyzing report, they wanted to respond to some of the specific allegations. Right, so basically they're saying, there's things like, a lot of work's done over cell phones, something to do with some of the code that's not put in there, and it's screwing up the data that Muddy Waters is looking at. Lots of different stuff. To be honest, I read over it. I'm still leaning on the side of Muddy Waters. I don't necessarily have a ton of trust in the information directly put out by GSX. If this was a third-party audit that concluded the same things and substantiated it and said that this is good enough evidence to refute what Muddy Waters is saying, I'd probably have a little more confidence in it. But let's say that Muddy Waters, let's take both of those and then look at the market and see how have people reacted to these pieces of news that have come out. Right? So when we look here, we see that the implied volatility is much higher than the realized volatility forecast. So what we're saying is that given the market conditions of right now, the market is betting on this thing making a big move. They're basically saying this thing's gonna move big. And we're saying that it probably actually will move a little less than what the market thinks. And the reason why the market is implying such a big move is crazy news has come out. And what that does is it drives up the price of all the options. So an option that, originally would be worth $5 because there's such a high demand for it and such a little supply, right? It's all supply demand balance. Who wants to be selling options right now? Right? There's no natural sellers of this thing like you would get in a typical movement of a stock day to day. And so that's why you see an inflated move projected for the future. And that means that the options are more expensive than they probably should be right now. The second thing that we see, which is really interesting, is the skew here, right? So Kyle, Michelle, you asked a question about what does this skew tell us? Since the right side is higher, does that mean the demand for puts is higher? Yes, it does. And the way we look at that is based on the deltas. So, these are the delta hundreds. These are the delta tens down here. So on this side, we're getting the put action. And on this side, we're getting the call action. We can see a small uptick in the, we have the 30-day to expiration, right? 30-day to expiration is the red. Blue is the the red is the 10 days to expiration. And the blue is the 30-day to expiration options. And we can see they're pretty much in line. So people think that this thing's going to move like crazy now and in the future. And when we break this down, we're looking at 172 implied vol for the out of the money puts. So people are basically willing to pay anything for downside protection right now. They're willing to pay anything. And look, given the reports that I've seen, I get it. There's a chance that this thing goes to the dirt. This thing could go bankrupt. This thing might not have revenue. This could be a total fraud. And, it comes from a pretty reputable place. So I think we need to take it pretty seriously. Hey, Thomas Cleary, if you don't mind me asking, what are these other reports saying? Are they corroborating what Muddy Waters is saying? Because, my research is limited on this right now, but the trade came from my business partner. So we manage a small private fund together. And he was like, you should go over this one because it's pretty interesting. So let me know what those other reports say. That would be really, really beneficial to know. Because if we're getting the same corroboration from all of these big funds, guys, you're crazy to be long this thing right now, even if it's moving up in the short term. Because all it takes is some more tangible evidence to come out that this is the case, and this thing could blow up. And by blow up, I mean burn to the ground, not blow up, go to the moon, like, SBCE or something. But yeah, so what we did was we looked at this and said, okay, we want to bet on it going down as well, but we want to take advantage of this skew. We want to take advantage of the implied volatility, and we want to take advantage of the skew. So the trade that we put on is we put on a long put fly. So we're basically taking advantage of the skew. We're selling here, and we're creating a range for ourselves in which we make money. Like this thing could go down 30%, 40%, and we're going to make huge amounts of money. I don't have Thinkorswim on this computer, unfortunately, so I can't show you the exact trade. But for you guys that want to see the actual structure of our trade, if you go to our Instagram, it's just Predicting Alpha on Instagram as well. In our story right now, we have a picture from the brokerage of the trade that we put on. You can see you can see how much we're risking, how much the reward is. You can see the exact structure, the range in which we make money. Be pretty good. What is the average volume increasing the past week, though? What type of institutions would take that chance? It can't be retail investors since the volume is so high. So Matthew, I totally agree with you. One of the things that I first looked at, right, one of the best tools, I'm not sure if this is how you came across this as well, is if you want to know what's going on in the retail space, take a look at StockTwits. Like straight up, it gives you a really solid foundation of what you can look at. What I typically look at are two things. I look at the sentiment, right? So we can see that, yes, a lot of the people are very bearish. The majority of the retail traders are bearish right now. Only 17% are bullish. And the message volume is something that I look at as well. And when I take a look at that, you can see that, when this news started came out, we got a huge spike. It's come down a bit, but it's ticking up again now. But like you said, the retail space, does it really have enough momentum to be driving all of this crazy skew, right? Does it have enough momentum to drive this volume? And my hypothesis is no. How do I come to this conclusion? because of the people who are actively watching this, there's only 2,000. Nobody's really looking at this thing from a retail perspective. So who is driving this crazy demand for the puts, this crazy amount of volume? And what I will say though, Chris, it's on our story. So take a look on our story. And if you have any more questions about that, I'll move over to my other computer after, which has our Thinkorswim platform on it. And I will break that. I will share that with you. Just shoot me a DM. Shoot me a DM and I'll happily put that up. Wow. No way. Thomas, that's unbelievable, man. Guys, if you take a look at the comments, Thomas Cleary was, he just shared some more information. You know, the Grizzly report came out, more evidence, 11% of enrollments are real. Guys, why the hell would anyone be long this thing right now? If you want to be, if you know, okay, well, I get why. Like, a lot of people can only be long stocks, you know, based on their trading in their TFSAs or whatever their setup is. But if that is the case, go to a different stock. Like, don't be long this stock. This is Fugazi, whatever you want to call it. It's smoke and mirrors, is what I'm thinking. So we want to get out of this one. So we have the 132 fly on. We're long the put fly. I'll throw that up on the Instagram. My bad about that. Oh, Chris, can you just confirm for everyone watching right now that that is on our story and it is enough for you to work with there? Because, dude, we're getting 15 to 1 risk reward on that trade. And our range is like 40%. It's a really wide fly. Like, guys, I think it's a no-brainer to throw something like that on. Don't over-leverage. Don't be throwing your whole account on this thing. That's just such a bad move, right? Like, look, you know, we don't want variance. We have a pretty big portfolio, but we don't want variance of more than like 1% or 2% in our portfolio. So if you guys, you know, trading smaller accounts, don't put up more than 10% of your capital on this. Really don't. Like, it could keep going up. And the thing about options that we got to remember, guys, is, you know, time decay's a bitch. Time decay kills people, right? And not only that, we have a directional bias. We have a skew bias. Like, there's a lot of factors in play to give us that leverage, but it's a solid play. When you look at the risk reward, even if you're right 10% of the time on a trade like this, you're making bank. So it's something that I think you guys should put on. Something to notice about the relative action. So some of the guys were talking about, you know, who was it here talking about the volume? Matthew, you were talking about the volume here, man. And, you know, when I go back here, something I want to point out to you is the volume is dropping off. So what I look at for when I want to know how much is going on around this stock, I want to look at it as a relative measure, right? Because, you know, you look at the day-to-day activity in a stock, you know, if it is high volume on a day-to-day, it's going to still be balanced. But you want to see when there's like pops in the action or a decrease in action. And what we can see here, and the way I look at that is I have a measure of it here, which is relative action, which is day-to-day how much action is going on, right? Like, you know, yesterday and in the past, this has been at a 10 out of 10. The relative action was a 10 out of 10, which meant that somebody was driving tons and tons of volume. But that has come back down now. So what this leads me to believe is whoever wanted positions is in their positions. There's not as much action going on around this thing now. So things are going to calm down. And all that we're really waiting for, and this comes into play, like you want to pick, you know, I wouldn't be trading the 10-day to expiration options. I wouldn't be trading the weeklies. I would give yourself maybe a month, right? 2 months, right? You decide that for yourself, how long you think it's going to take for this thing to really get exposed in any way more. I would say it wouldn't take long. Something we can look at though is, you know, if you thought like it might take for the next earnings or something, you know, we take a look here. Their next earnings isn't until August, end of August. So I wouldn't be holding out for that. And we also know that if these reports are holding their weight, they're botching the numbers, right? The revenues are looking a lot higher than they are. They're basically saying the revenues aren't real. So we need to be extremely careful about this stuff, guys. That's the trade that we're putting on. If you guys want to send me a DM on Instagram, I'll be more than happy to help you guys out with structuring a trade, you know, sharing a little bit more about what our positions are or how we found it and how we use the data to structure it. But guys, I want to do something kind of cool now. Thomas, you think IMO October is a safe expiry, next quarterly report? Yeah, but what do you think about what I shared there, which is that, you know, if you're waiting for the earnings report, but we know they're botching the numbers, aren't they just going to be more botched numbers? How is that going to be the catalyst that does it? It'll probably be if they can't afford their bills, or if we get a massive, what's the catalyst that's really the straw that's gonna break the camel's back here? Do you think it'll be that earnings? Let me know your thoughts on that, guys. But I want to show you guys something else that's cool, right? If you guys have any other trades that you want me to take a look at, let me know, because what I'm going to do now is I'm just going to go over a couple other trade ideas. I don't necessarily have them off the top of my head, but I'm going to use my scanner here. I like to come on in the mornings and just help out a bit. So if you have any trades that you want me to break down, let me know. If not, I'm just going to do a scan for some good short vol trades right now. So, what we like to do, what we do with our private fund is we're pretty much always 9 times out of 10 we're short vol. We're collecting that risk premium, and we're just structuring out trades that let us capture a difference between implied volatility and our forecast of volatility. So we use a bunch of mathematical models, like we use GARCH models, correlation to SPY, beta vol, non-earnings IV20 to sort of break it down. So I'm just going to use some of that to find some trades for you guys. The way that I sort of look at things is, if we go over 4 or 5 trade ideas here, the way that we would take it is, if you agree with all those trade ideas, place a small bet on all of them. Because what this data does give us is, we're looking for, what we're doing here is basically a form of stat arb. So we're looking at the data, and we're seeing where there's an inefficiency, and we're trying to capture the spread. So we never want to put all our eggs in one basket on something like this, but what we do want to do is spread our risk across many, many, many trades. So to give you guys an idea, last year, my partner Jordan and I, we placed over 2,000 trades. We trade a lot of earnings, so we have really high volume of trades. We placed 2,000 trades. We got it right 57% of the time. So 57% of the time, we were correct on our bet, and it resulted in a net of 73% on our portfolio for the year. And that's on the entire portfolio. We've been averaging about 70% year over year for 3 years now, and we're on track to do over 100 this year, following a similar methodology. This is really what they mean by quantitative trading. So you're basically taking simple statistics and using it to test your hypothesis before you put your money behind an idea. So I'm going to go through here right now. I'll show you a couple of the filters I use. So this right here is my vol scanner. So things that I look for stocks that have at least a $15 price point. So I'll go here, 15, boom. I want to have an average option volume of at least 5,000, right? We want to be trading somewhat liquid things. Worst thing is if you make money and then you get stuck in a position, that's bullshit. And then let's have a look at what comes up. So let's take a look here. Tiffany still has this skew going on. This is one that I took a look at yesterday. So this is one that we would still be holding. Guys, so what happened with Tiffany was, and you know what's so funny about Tiffany? I actually called this when coronavirus started. They were just going into a deal where they were going to be acquired by LVMH, and I called it. I was like, you know what? With all this crazy shit going on in the world, there's no way this deal's going through. And guess what happened? The deal didn't go through. But let's look at what happens now, right? What do we do now? And you know what? So far, my prediction's been coming true since I made it yesterday, which is that the market is overreacting to it. They're thinking that this stock is going to move like crazy. They're implying almost 50 implied vol, which is, if we do our quick maths here, they're implying a 50 divided by 16, right? Square root of time. This is an annual implied vol. So we want to break it down to time. So we do square root of time. We're seeing here a 3.1% move day over day implied by the market. And what we're saying is that we think the implied move is actually going to be something closer to 1.6%. So we think that it's going to be about half the size that it is. So what I'm saying here, guys, is basically we want to be shorting volatility here. I don't necessarily have a directional bias on this one. So for you guys that like to trade direction, this won't be for you. But what could be for you, if you guys want, remember, options are volatility products. First and foremost, they're volatility. If you don't understand the volatility of how volatility impacts an option, a book that I highly recommend you go read is Option Pricing and Volatility by Sheldon Natenberg. That's basically the Bible of options trading. Go read that thing, and You'll never fall scam to any of these mentor groups out there. You'll know exactly what you need to do, but you'll also realize the complexities and intricacies of the space. But that's actually where alpha is generated, is in these complex products where you can find an edge. There's a lot of like structural reasons why. There's a lot of like psychological reasons out in the market that we can take advantage of. Looking at Tiffany though, relative action is still a 10 out of 10. So this is something that I like to see. There's still a ton of people trading it, keeping the price of these options up. So what I would do here is I would structure an at-the-money iron condor, and I would just take advantage. I would be non-directional, and I would simply take advantage of the implied versus realized volatility. Right? Lots of things indicate that this is how it's going to be. Since I first called this out, the stock hasn't really been moving much anymore. We got to think about it like this. We already know that the deal is at risk. So until we get news that confirms whether the deal goes through or if it doesn't, like 100%, we're probably not going to get a big move again. But this is what happens when big news comes out for a stock. We end up in a position where now people, they look at it and they think that something's still going to happen. They think there's going to be more of a tail of volatility for the stock. But markets are too efficient for that shit. It just doesn't happen anymore, right? The market is just as well as you trying to forecast what's going to happen in the future. So that's why when we look at something like this and we see that the implied vol is still really high, it's still bid. That's what they'd say in the trading world. It's still bid. We want to be selling it, right? Because they're overpaying for a premium, and the move is probably not going to be that big. By the way, guys, it's super awesome to see that we got 16 people in here. That's like one of our biggest lives ever. We're really trying to bring this whole quantitative approach to people, really trying to help people out, get people thinking critically about trading, and break down popular trades. I'd love your support, guys. Drop a like and a subscribe. It'd mean the world to me, guys. Thank you so much. So, Chris, you had a question here about Zynga and ZM, and I said I'd do a recap. You're in both, but likely different positions and strikes. Would like to hear your thoughts if you're still in the trades. So I am not in either of those trades right now anymore. We were in the ZM trade for the earnings event. So if we take a look here at the earnings tab, so I'm looking at ZM right now, right? When was this? Okay, yeah, so it was on the 2nd. Yeah, sorry, guys. Honestly, I'm flying through trades these days, so hard to keep track. It was a good trade. It was a really good trade. It was kind of a risky one because the thing is, when we're looking from a data-driven perspective and we're trying to apply numbers to our ideas, we need a large sample. And if you exclude this box here, we only had 4 earnings events to look at to determine what the average move on earnings is for ZM. What's the distribution of moves? How does it move seasonally? And compare all that to the market implied volatility. So little tricky to do, but we decided to go ahead with it anyways because it was pretty juicy. Thinking about it, if I recall correctly, when I had taken a look at it, so Chris, when I had taken a look at the implied volatility in the morning, it was 12% implied by the market with a 10% average move or 9% average move. But by the close, right? So when I trade an earnings event, I buy at the close because I'm trying to isolate the event. So when I bought it at the close, it was implying 18%. The move had shot up like crazy. Huge implied move. And I was like, you know what? I'm in. And I believe we cashed out like, we made about 40% on that position, which was pretty juicy. But one of many that we want to do, right? We had a small edge there. We had a small edge we're playing with. I got out of that position pretty much right after that. Siddharth, if you're still in here, so Siddharth's one of my buddies. I believe he took the Zynga trade. I didn't actually take the position. I just broke it down because, buddies were looking at it. It was a good trade. Taking a look at it now, though, there's still an edge. So here's how I would give you advice to manage that position. So I would do a couple of things. First of all, I need to know what position you have on, right? So different positions require different forms of management, but I'm going to go ahead and assume that you're just short volatility until you tell me otherwise in the comments there. Here's what we do, guys. So when we have an iron condor on, we're basically saying that volatility is overpriced, and then we buy protection at the wings, right? Because we don't want to be, unlimited exposure to our risk. And what we're basically saying here is the way we would manage it is we look for a couple of different things. One, if the stock price moves and touches one of our wings, we're at our max loss, and things actually flip as it crosses the wings, so we're out of the position if it touches one of the wings. The other thing we look for is if the edge is still there. So the implied vol versus the realized vol. Right now there is still a spread, and if I take a look, I believe, is it gotten bigger? Let me have a look here, guys. No, so it's about the same. So the edge is still there. Oh yeah, Siddharth Damveer was taking that trade. You're correct, man. Sorry about that. The edge is still there, so I would still be holding the position. Given the fact that it's not touched one of the wings, most likely, I'd put them one standard deviation out on this. So you'd take the price of the straddle and then go either side of the at the money price, and that's where I'd put the wings. If it hasn't touched the wings, the edge is still there, I would still be holding the position. Because guys, this is the trap that a lot of retail traders fall into. They cut their winners early and they let their losers run. And it's the reality of what happens when you don't have a strict plan going in. So when you set these sort of more quantifiable and defined reasons for entering and exiting your trades, all of a sudden, the second guessing yourself and all of this goes out the window. Now you have a structured reason as to why you would enter and exit a trade, and you don't have to rely on your own intuition to sort of feel it out anymore. We have reasonable understanding of why we're getting in and out of positions, right? Whether it's a win or a loss, we know exactly how we're doing it. What did Chris say here? Right on, made 50% after earnings and reapplied a wide iron condor to take advantage of after earnings contraction. Dude, good shit, man. That's so cool. I'm really happy to hear that. Damveer, yeah, man. Learn your lesson. You don't want to be getting out of these positions so early. You want to be holding it if the edge is still there. Otherwise, you're leaving money on the table, right? It's hard though. I know, man. Like when you're first getting going here, it takes a while to get to this point where you can actually hold through a profit and not take money off the table, right? And then it's gonna be really hard to cut your losers as well, right? So we gotta really be on top of our game for that stuff. It's gonna be a long-term make or break difference. Okay, so and Chris is saying that Zynga never came in enough for him, so he's still in it for a minor profit. Very cool, man. Very cool. Look, I think you should still be holding Zynga. If I had a position in this, I would still be holding it. And guys, here is, you know what? Like when I was told this for the first time, it changed the way I thought about trading or managing my positions at least. Ask yourself this question if you are contemplating getting out of your trade or entering into a trade. If I had no position right now, would I still take this trade? If your answer is yes, stay in the position. If your answer is no, get the hell out. Right? Like I had a buddy who was looking at GNUS, right? It's some penny stock that shot up like crazy. He messages me the other day and he goes, or he messaged me yesterday. He's like, yo man, I bought this thing at $2. It's at $10 right now, or it's at $8 right now. I bought it 2 days ago. And I'm like, dude, okay. He's like, I'm wondering if I should sell or if I should keep holding it. And I'm like, ask yourself the one question. If you had no position, would you be buying it right now? And he was like, hell no. So I was like, you answered your own question. Get out. And it jumped another 30% today. And he messaged me. He was a little upset about it. And I said, dude, if it had gone the other way, you'd be crying if you were holding it. And this is the game we play, right? You need to have a confident reason why you're getting in and out of trades. And you need to roll with it. And then move on to another trade. So that's the thing, guys. I appreciate some of you guys that are tuning in here. Like Chris, the fact that you've come in a couple times here really makes my day, man. Like that means a lot to me. Really does. So if you have any trades in particular that you want me to help you break down right now, more than happy to do it. But if not, guys, I'm probably going to wrap it up for today. I'll look at one or two more trades right now, just so you guys have some stuff to work with for today. And then besides that, we're going to be back at it tomorrow morning. I'm hoping that tomorrow my partner Jordan can join me on. We may do something a little bit different. Sometimes we like to come on here. I don't know if you've seen it yet, Chris. My partner and I will come on and we'll just have a chat about trading. Couple things about us. We raised just under 7 figures in tradable capital. So like we have just under 7 figures of assets under management. We've done 70% year over year for the last 3 years on that fund. And in 2019, we actually won the biggest options trading competition in Canada. It's called the TMX options trading competition. So we like to talk about sort of our journey and some of the mistakes we've made, some of the things that really were game changers for us, why we work with data, why we think that things are the way they are in the retail space. Yeah. So Thomas, I would have to, if you're talking about the Zynga trade, I would be doing an at the money straddle. And then, sorry, I don't have my my brokerage on here that I can really use to break it down for you on the brokerage. But here's what you do. If you want to sell an Iron Condor here, price out the at the money straddle. So let's say you price out the at the money straddle and it's $4. So we would go, or okay, well, it's a $9 stock right now. So let's say it's $2. We would go to the nearest at the money strike and buy and sell that $2 straddle. And then what we do is to pick our wings, we would move the price of the straddle out each way. So right now we'd be selling it for, $1, let's say at a $9 strike to make it easy. Oh, GSX. Thomas, take a look on our Instagram story. We have our exact trade put up there. So Instagram.com/predictingalpha. Here, I'll type it in here. At predictingalpha on Instagram. And if you have any more questions as well, you can shoot me an email at sean@predictingalpha.com. Yeah, we have it right there for you to see. But yeah, the way you want to be picking your wings on average for an Iron Condor, take the straddle price, move either direction out from the at the money point, and that's where you want to put your wings. And those are what you're also considering your exit points if you are in a losing position. Fingers crossed. But at the end of the day, guys, don't worry if you have a losing position. You shouldn't be in a position where you have everything riding on one trade. So it shouldn't kill you to have a loser once in a while. Like I said, guys, we were only right 57% of the time last year. And it was enough to almost double our portfolio. And that's what that is the reality of trading. Trading is a game of probabilities. It is a bet. Every time you place a trade, it is a bet. So we want to keep that in mind. And all we want to do is be playing with an edge. If we can prove that we have a quantifiable edge and a positive expected value, meaning that on average, we're supposed to make money on the trades that we have, similar to how a casino with a roulette table, on average, a $10 bet, the casino is supposed to make 20 cents, something around that. We want to be playing trades like that. And it's working with data, combining it with intuition, structuring our trades to capture, stat arbs, things like that. That's how we really win in this game. It's the reality of it. And once we have that, all of a sudden now it's like we got to focus on our psychology, all this stuff. But let's make sure we're playing a winning game here, guys. So come back tomorrow. If you guys have a particular trade that you want me to take a look at, let me know. And I'll be more than happy to break it down. Ryan, thank you, man. Honestly, I'm so passionate about this stuff, guys. Like, dude, this is... I want to change the game here for everyone. I want to get people thinking about trading critically. Look, I was lucky enough to have, a big fund manager in my life, right? So from pretty early on, maybe a year or two into my trading, I kind of got shown the right things to look at, right? A lot of people look at the technicals and they're looking at these things, and there's nothing wrong with technical analysis in and of itself, but there is something wrong with subjectivity because of a couple of reasons. One, you don't know if you have an edge, and even if you did have an edge, when the edge inevitably goes away, how do we know if it works? We can't test our ideas. We can't actually analyze what's going on. And we can't scan and place enough bets to really come out winners in the end. And that's the biggest difference between professional traders and the average trader right now, is the ability to critically analyze, apply data with your intuition to actually find good trades. And then knowing your product well enough to structure out trades to really take advantage of any inefficiency that you find. And that's what I really want to promote on this channel. If you guys have any questions, send me an email to them. I left my email there. I'll make a video on any of that stuff. My partner's really smart too. We're all in on this. We want to make tons of content for you guys and really get people on the right track for trading, because the tough part is, guys, it might take a few years to realize if what you're doing is right or not. And, a lot of the guys I talk to, it's a hard realization to come to, but eventually, if you aren't on the critical thinking path, and I'm not saying you guys aren't, but really stop and think about it, because you might realize that a lot of people are simply learning strategies at a roulette table. And it's a tough reality. I had that reality. I realized one day, holy shit, everything I look at has no edge. I have no idea what counts as tradable information. I used to look at companies and go, they have XYZ catalyst coming up, right? I think it's good. The fundamentals are good. Things are looking good. And yeah, you can build a strategy off that potentially. If you read The Little Book That Beats the Market by Joel Greenblatt, that's pretty good proof that you can build a strategy off that. But is it tradable information? If I'm trying to buy now and sell 6 months in the future or 3 months in the future, the market is forward looking as well. Is that stuff really giving me an edge to know? This is why we look at information like this. This is why the data matters. Because without the data, you could be wrong and you won't know it. So that's why, guys, go online, look up data-driven trading, do your research, learn to code if you're all in, learn how to work with the numbers. And if you have any questions, anything I can help with, I love this shit, guys. Shoot me a message. But for now, I'm going to be wrapping it up. It was a pleasure, man. Thanks, everyone. We'll talk soon.